Do you ever find yourself wondering about the intricate world of finance? More specifically, the difference between private equity and a hedge fund? Well, you're not alone. Today we delve into these two financial concepts, breaking them down in a way that's both digestible and engaging. First, we'll tackle private equity. Picture this. An investment management company has one primary goal: to invest in private companies. They acquire these companies through funds collected from wealthy individuals and institutional investors. The goal is simple: enhance the company's value over time by improving its performance and then sell it off for a profit. This process, ladies and gentlemen, is what we call private equity. It's a long-term game, often taking several years to see a return on investment. On the other hand, hedge funds operate on a different playing field. Imagine a pool of funds collected from high net worth individuals and institutional investors. But unlike private equity, these funds are invested in a diverse range of assets. It could be stocks, bonds, commodities, or even real estate. The goal here is to generate high returns and fast. Hedge fund managers use complex strategies to achieve this, often involving leverage, short selling, and derivatives. It's a high-risk, high-reward scenario. While both private equity and hedge funds revolve around investing large sums of money, their strategies and goals are what sets them apart. Private equity is about strategic, long-term growth, while hedge funds are about quick, high returns. But that's not all. Let's consider the risk factor. With private equity, the risk lies in the ability to improve a company's performance and increase its value. It's a calculated risk, but a risk nonetheless. Hedge funds, however, are often considered riskier due to their investment in volatile markets and use of complex strategies. Another key difference is the level of involvement. In private equity, the investment management company is heavily involved in the operations of the company they acquire. They're in it for the long haul, steering the ship towards growth and profitability. In contrast, hedge funds are more about passive investments. They buy assets with the expectation that they will increase in value but don't involve themselves in the day-to-day operations. In summary, private equity is about acquiring companies, enhancing their value, and selling for a profit over the long term. It's a hands-on approach with a calculated risk. Hedge funds, on the other hand, invest in a diverse range of assets with the goal of quick, high returns. They take a more passive role, but the risk is significantly higher due to their investment strategies. In the grand scheme of things, both private equity and hedge funds play vital roles in our financial ecosystem. They each have their strengths and weaknesses, and their strategies and goals differ significantly. But one thing is clear: they both aim to generate substantial returns for their investors. Whether it's through strategic long-term growth or quick high-risk investments, they continue to shape the financial landscape as we know it.